let's bring in someone for some instant reaction to some of these numbers. Joining us now, Marty Mosby, Vining Sparks Director of Bank Advisory and Strategic Services. Marty, your first reaction to these numbers?
Yes, so the things that we're looking for is how do we preserve our capital, which means you have to earn your dividend or better. JPMorgan's dividend is 90 cents a quarter. They just earned $1.38, so they're preserving their capital and they're creating a cushion so they can sustain their dividends. Those are the two things that we're watching for in each of these quarterly results. That one number tells you pretty much all you need to know. The only other thing that we're going to be looking for is how much they put in provision. Last quarter it was $8 billion. They were growing their allowance to loan losses significantly, and that's covering those potential losses that we'll eventually see on the credit side, which probably won't materialize till later this year or into 2021.
Are you thinking that second quarter will be peak provisioning for JPMorgan as well as the other banks? Or is it so much of an unknown that we could see even more in the back half of the year?
Well, this is a very interesting dynamic that's going on. We're looking at this loan loss and the provisioning. Because of the new accounting, it accelerates the recognition of losses. Because of the way that this economic recession is occurring, that dropped so quickly, unemployment went historically high. So there's many metrics that will generate extra provisioning given what we have in the new accounting. So we're probably going to have the biggest gap historically between what we're providing and the losses that we actually realize. For instance, let me give you an interesting statistic. This quarter, we're estimating that the banks in the United States will increase their allowance for loan losses to loans from around 1% to over 2%, increasing 100 basis points, almost doubling in 2 quarters, versus what we saw the last cycle, which was about 6 quarters for them to get to that level. So the incremental provisioning will generate that coverage for those losses, which will occur later. Right. And then what we do believe is the improvement we'll see in the third quarter could actually let that provisioning go down as we go from second quarter to third quarter. So there is an improvement in front of us.
We're getting some more headlines here from the release. Pardon me, I haven't seen the full release yet, so these are headlines. But JPMorgan Chase second quarter credit costs $10.5 billion, including reserve builds of $8.9 billion. Firm-wide reserve builds due to COVID-19 cut second quarter EPS by $2.19. Those reserve builds of $8.9 billion, Marty, sounds like more than what many on Wall Street had been expecting. I think many were expecting in the order of $8.1 billion in loan loss reserves.
That's exactly right, but that's even better. So when you're seeing that those loan losses and provisions are going through, and yet the earnings were still, over what they expected, they had the extra fees coming from capital markets and from mortgage. So those are things that are kicking in, which are helping us cover some of these expected losses going forward. So what we're watching for is, can we provide the most for the expected losses? Can we still preserve our capital, which they're doing? Tangible book value will grow this quarter again, not go down. And they're over-earning from their dividends. So sustaining of dividends is also in place. So those are the 3 things we're watching. They're checking off all those boxes right now.
Second quarter provision for credit losses, $10.5 billion. Return on common equity, 7%. Return on tangible common equity of 9%. In the conference call, Marty, what will you be looking for specifically? What do you want to hear from Jamie Dimon about?
Well, again, what we're going to be able to get is some color to what they're seeing inside the loan book, in the credit losses that are kind of going through and percolating through as we're starting to see some dislocation. What are deferrals? So how are they managing the credit cycle? The second thing we'll be looking for is net interest margin, because once the credit cycle finishes sometime next year, the exit velocity that would come out and the returns that we'll have in profitability will be all predicated on what is the net interest margin. So as they're managing, have they kind of recalibrated their deposit rates back to 0 again? Are they being able to defend what they have on the loan yield? So those are the 2 variables we really have to watch very closely to get a feel for the real valuations here.